Hello, and you're welcome to Global Business Insights, where you get more on the main business headlines across the globe. The headline Personal Consumption Expenditure Price Index increased 0.3% last month. That's April, month on month, matching the unrevised gain that we saw in March. The core month on month index also rose 0.2% as expected. We also got the May US Chicago Purchasing Managers Index, which captures business conditions across Illinois, Indiana, and Michigan. That was down to 35.4 from 37.9 the previous month, also less than expected. Latest data today showed UK house prices rose 0.4% in May, more than economists expected, also ending a 2-month drop. Is Africa at the cusp of a different transformation, or is it the familiar rhetoric in new skin as the African Development Bank Group unveiled its new 10-year strategy 2024 to 2033 this week and launched the African Economic Outlook 2024? We will replay our analysis on the annual meeting. In South Africa, we saw some recovery in the rand, pairing previous days' losses, but it's too early to say how this goes as investors hope for a coalition with a more market-friendly major opposition party. And we also replay our chat on Saudi Aramco's $12 billion stock sale kicking off this weekend, and Opec Plus also meeting. The change in the Federal Reserve's preferred inflation measure came in as expected in April, confirming progress in controlling price growth in early 2024. The April Core Personal Consumption Expenditure Price Index came in at 0.2% month on month as expected, and 2.8% year on year, also as expected. The year over year change in the headline PCE price index was 2.7%. The Fed has a 2% annual inflation target. Disposable personal income data was up 0.3% as expected, while there was a slowdown in personal spending, up 0.3%, lower than 0.2% expected, and lower also than a revised 0.7% in the previous month. The initial reaction of equities futures upwards reflects the dovishness, potentially raising odds of rate cut, but not enough to convince the Fed to do anything materially different in June or July. The probability of the US Central Bank leaving the policy rate unchanged in September was at around 48% ahead of the report. The chances may have inched up a bit. Many analysts still say there is really no pressure for the Fed to cut rates at all with what looks like a solid economy. The reading, however, triggered a US dollar sell-off as the dollar dipped down 0.25%, gaining back some of those losses later in the day. Like I said, the spike in equities initially, because most of those gains were given up, suggests relief that the numbers did not present an already priced in upside surprise. Next week, the expectation was that ECB will cut rates with 25 basis points cut already priced in. However, today's inflation data from the Eurozone, both headline and core HICP, exceeding the forecasts, may be concerning in that they could affect the Thursday ECB decision. Annual inflation rate in the euro area picked up for the first time in 5 months to 2.6% in May 2024 from 2.4% in each of the previous 2 months, and above forecasts of 2.5%. Inflation accelerated more than expected in Germany, up 2.8%, in France up 2.7%, Spain up 3.8%, and Italy up 0.8%. Suddenly, a cut next week may not be looking so obvious as we see this fresh conflict with the previous ECB dovish undertones. First, on oil markets at their meeting, OPEC Plus this weekend is likely to extend the current production curbs and address a growing volume of unused capacity in the oil market. Analysts see reductions amount to about 2 million barrels per day, also leading to a growing volume of unused capacity. Another significant event in oil markets is the formal announcement by the government of the Kingdom of Saudi Arabia and Saudi Arabian oil company Saudi Aramco of a secondary public offering of 1.545 billion ordinary shares, representing less than 1% of the company's issued shares. The offering is set to start on Sunday, June the 2nd, and it will go on till June 6th, marking a significant event in the global energy markets. Saudi Arabia is selling roughly $12 billion worth of shares in this sale as the kingdom seeks further capital for its sovereign wealth fund. According to Amin Nasser, the chief executive of Saudi Aramco, he said the timing of the sale had been decided by the government and that the offering was an opportunity for Aramco to broaden its international investor base. The Saudi government is cautiously diversifying out of fossil fuels, harvesting its equity to invest in new digital technologies in an ambitious economic diversification plan, as well as milking Aramco to fund new mega projects to fuel its economic growth. Oil prices continue to see more downside, with US markets seeing ample supply amid a weaker than previously estimated Q1 GDP print. The Opec Plus video conferencing meeting this weekend will, apart from quotas, shed light on compliance with agreed cuts. Brent crude standard, the crude oil front month, is under $82 per barrel as we speak. It's obvious that prices can still come down as current prices include a significant risk premium, which is slowly falling as geopolitical risk calms, albeit there's still a bit of uncertainty there. EVI had predicted in January an average of Brent at $75 to $80 as demand remains capped by tepid global economic growth. The wild card being, of course, the toxic Middle East geopolitics.
One is the era of cheap money is gone, so everything it gets very expensive. Second is the structure of the debt itself has changed. We used to have before, in 2010, roughly about 57%, I would say, like that, of Africa's debt was concessional debt, bilateral debt. Today, that has gone down to 25%. But you see the opposite side has happened. You found that commercial debt, private commercial debt, Eurobond debt now dominate. Used to be 17% then. Today, we used to think they're about 45%. Now they are probably about 55%. And those things have implications. They're short-term debt, they're expensive debt. And at the same time, you find because of the huge amounts of Eurobonds that have been issued, you have bullet payments that are due. And so there's accumulative things that are there that risk our economy. So we need to find out ways to make sure we have debt resolution, debt treatment for African countries.
Banks and accountants typically do not play as important a role as the leaders and the entrepreneurs and visionaries. But in the 19th century, the likes of JP Morgan and the great financiers partnered with the Carnegies to build the foundation of the industrial age. Today, we are in a different digital age. The geoeconomic complexities are recalibrating capital flows, and Africa remains disadvantaged. The Bretton Woods institutions that emerged after the Second World War focused on reconstructing a war-damaged Europe. NATO emerged to ensure Europe was safer and stable for investments. The World Bank and the WTO, World Trade Organization, sought to establish rules-based trade and global financial rules, which at the time saw Africa as a terrain with rich natural resources but with hidden dangers, justifying investors' demand of higher returns and higher costs of borrowing, which continues to hurt the continent, while harvesting cheap resources, which of course further hurt Africa as limited value was added locally. Africa Development Bank Group is trying to change the narrative for Africa. Its optimist-in-chief President Akinwunmi Adesina, in his final year at the helm of affairs, says AFDB is going to be Africa's solutions bank, and is acutely aware that the next decade will be decisive in transforming the continent. Priorities include promoting access to affordable energy, ensuring food security through agricultural transformation, and catalyzing manufacturing as a critical driver of job creation, as well as fostering regional integration, all to enhance living standards. The new 10-year vision of a prosperous, inclusive, resilient, and integrated Africa is supported by solutions such as promoting good governance, investing in women and young people, climate change adaptation, supporting fragile states, and building resilience. There are a few important themes. For example, Africa is home to the world's most youthful population, with a demographic dividend arising from skilling up and harnessing a powerful potential, with many opportunities disguised as gaps. Africa is also urbanizing faster than any continent, creating vast opportunities for growth. The just released Africa Economic Report says average growth in real GDP fell to 3.1% in 2023 from 4.1% in 2022, but the forecast for 2024 to 2025 is looking promising as global economic conditions brighten. Real GDP growth is projected to rise to 3.7% in 2024 and consolidating higher at 4.3% in 2025, underscoring Africa's resilience and benefits of policies putting economies back on a higher growth trajectory. My conclusion is that beyond well-meaning aspirations, first, who succeeds Adesina in championing and leading execution as he leaves the African Development Bank, and to what extent is this vision shared and bought, and what are the clear next actions? Second, the West is presently preoccupied in a tough geopolitical context, and one can expect less support at the continental level for African causes, implying Africa and especially its leaders have to do more to speak for the continent and to solve its own problems. Third, expecting lower risk ratings for Africa simply because the Afdb says so is somewhat naive. Africa must act more decisively to de-risk its environment, and leadership needs to unite to enhance attractiveness factors. The low-hanging fruit could be the acceleration of regional integration. After a 3-day losing streak, the rand earlier today paired losses and strengthened as much as 0.6% and traded 0.2% stronger at about midday, only to give up the gains, now down 0.49%. ANC was set to win about 41% of the vote, a far cry from 57.5% it obtained 5 years ago. There is much uncertainty about which way things are headed, and the implications of a coalition are not exactly clear, and what it means if ANC loses parliamentary majority. It all comes to the speed and nature of coalition talks and who the partners will be. And of course, a partnership with the less market-friendly parties could mean repricing of South Africa risk. Investors are reported to be favoring an alliance with the Democratic Alliance, which has stood for free market principles and which also looks set to retain its position as the main opposition. Dell late yesterday reported Q1 revenue of $22.2 billion, up 6%, which was ahead of both forecasts and the consensus for $21.7 billion among analysts. Profits came in at $1.27 a share, in line with consensus, but not good enough as Dell shares sank over 18% in early trading. As we speak, Dell is down 22%, and it may be a combination of profit taking and an earnings beat that was below what many had expected. Backlog of business also looked weaker. Notably, ahead of the result, Dell shares had rallied 124% for the year to date, so it may be a case of too much already priced in. European stocks today were mostly higher as fresh Eurozone inflation data came in and as markets anticipated an ECB interest rates cut next week. Johannesburg Stock Exchange All-Share Index down 0.5%, the Rand also down 0.49%. Other indexes closed mostly positive in Europe. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and for the kind comments and following or subscribing on Facebook, LinkedIn, or YouTube and X. Thank you very much for watching. Bye-bye.